Good day everyone, my name is Dominic,
And I'm Jimmy.
and if you're new to the channel, welcome. If you're not, thank you so much for supporting us all this while. Just remember that every like and subscription you give us goes a long way in supporting our production of videos. Wait, before that, disclaimer. None of the content produced in this video should be used as a substitute for professional investment advice, nor does it constitute an offer or solicitation for investment-related products. It will also not induce the creation of any binding legal relations. Okay, for real now.
On this week's podcast, we'll continue talking about the health issue that is on everyone's mind right now. As usual, for the sake of moderators, we'll be calling this health issue a coconut.
We'll first talk about a statistic that we just discovered recently, and that is how consumer spending is actually 70% of the United States gross domestic product. This is a deeply troubling statistic because it only means that the longer people are contained at home, the more bad shape the US economy will be in. The US Federal Reserve is facilitating companies to accumulate more debt in order to survive. But what they are fundamentally unable to create or sustain is consumer demand. The consumers are all trapped at home, and companies that are in trouble or have had historically bad management before this crisis were already in too much debt. It could also be argued that this debt overload was actually the Federal Reserve's doing anyway, because they kept interest rates too low for too long, and many consumers like us are just forced to go into equities rather than investing in safer stuff like bonds. Companies that are already paying little in interest costs put their earnings into stock buybacks instead of reducing their debt loads in a bid to sustain their current market prices, which translates into a worsening impact on the consumer.
No wonder we have stocks selling at crazy multiples for companies with terrible balance sheets and with diminished demand prospects and little profitability. Throwing money at this mess will fix their balance sheets anytime soon. A lot of these companies should just go through Chapter 11, wipe out the bond and stockholders, and reorganize clean, lean, and mean with new ownership. Extending credit to every POS company, just incentivizing more irresponsible corporate behavior.
What's Chapter 11?
Basically, part of US bankruptcy law, which involves a reorganization of companies' businesses and debts, including a possible change in ownership.
Sweet! Okay, so moving on to the last issue we want to talk about.
Deflation.
Yeah, that's right. Seems a bit counterintuitive considering all the money flooding the market. Deflation will actually happen because the prices of everything will have to drop for people and retailers to sell things, since they do not even have much money on hand and the onus is on them to earn much more. And it is not as if this deflationary trend will be a short-term thing, because I feel that it's going to stay the same way for a few years down the road. If you look at all the past historical charts, the world has rarely been in deflation for a prolonged cycle. So if I'm actually calling the shots right, it makes the effects and consequences even more unprecedented.
I see. As our favorite hedge fund manager Ray Dalio
love that guy.
mentioned, we think that interest cuts and quantitative easing will be significantly less effective in the next downturn for reasons we've described in depth elsewhere. We also don't believe that monetary policy is producing adequate trickle-down. Quantitative easing and interest rate cuts help the top earners earn more than the bottom because they help drive up assets prices, helping those who already own a lot of assets. And those levers don't target the money to the things that will be good investments like education, infrastructure, and R&D.
To sum up this video, it is true that the Federal Reserve can pump in a lot of money. But the problem is, the money cannot go exactly into the position where it left. For example, if it is the retailers who are losing all the money in this economic downturn, how can the Federal Reserve guarantee that the payouts that they are giving to ordinary US citizens will necessarily be spent on the same retailers that are badly hit in this crisis? So in the upcoming next few months, I'm almost 90% sure that there will be a period of economic instability as well as a retest of the lows. Just look at the VIX chart if you're still not convinced. Again, we welcome as much feedback on our channel, and we make it a point to digest as much economic news as we can before making each and every video. If you want further reading of our sources, please check out the web pages listed below in the video description. Okay, that's it for this week's video, but me and Jimmy were thinking of releasing a few videos doing technical analysis on potential stocks that we are holding, as well as stocks that you may consider buying. We're able to do it for both Singapore markets as well as the US markets. Let us know whether this will be helpful to all of you in the comments section below. We have come to the end of this video and I hope to clarify all your doubts. Again, it will mean so much of us if you leave a like and subscribe to our channel. Thank you and see you in the next video.
Ever since the day that you